I'm Abhilash Narayan, investment strategist at HSBC. Welcome to the latest edition of India Brief, where we discuss our latest house views about Indian equity and fixed income markets. Now, the ongoing conflict in the Middle East has now surpassed over 1 month and has caused significant disruption to global oil and gas supplies. While there remains a considerable degree of uncertainty in terms of how the situation could evolve, higher oil prices are clearly a negative for India, given India's dependence on oil imports from that region. In a scenario where oil prices average $80 per barrel, we expect India's GDP growth to slow down to 6.3% compared to our previous forecast of 7%. While the recent reduction in fuel excise tax is a positive for consumption, it is likely to result in lower tax revenues and has led to an increased risk of modest fiscal slippage. The Reserve Bank of India is likely to adopt a wait-and-see approach as it assesses the impact of higher oil prices on the inflation. We have also revised our FY27 inflation forecast higher to 4.5%. So, what does all of this mean for financial markets? We have made some changes to our asset allocation. Firstly, we have reduced Indian local currency bonds to a neutral stance. While the bonds continue to offer an attractive yield of over 7%, we see three headwinds for them in the near term. Firstly, the risk of fiscal slippage is likely to result in higher bond supply, which would lead to unfavorable technicals. Secondly, higher inflation means that RBI is unlikely to cut rates anytime in the near future. And thirdly, the weak investor sentiment is likely to lead to continued foreign investor outflows from the Indian bond market. So when we put all of these three factors together with the attractive yield on offer, we think that the risk reward has become somewhat balanced. We have also tactically downgraded Indian equities to a mild underweight in our globally diversified portfolio, as we believe that they are likely to struggle to outperform global equities until oil prices stabilize. However, our relative preference between equities and bonds remains unchanged for domestic investors. While valuation for Indian equities have cheapened significantly over the past few months, we see risks of margin compression and continued investor outflows as near-term headwinds. We therefore favor the more defensive large-cap stocks over small and mid-cap stocks. And from a sector perspective, we are overweight on financials and industrials, but we have downgraded consumer discretionary sector to a neutral.